Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. Welcome to Money Talk for the final day this week, Friday the 7th of July. There are several places where you can find this show. Look for Peter Lewis's Money Talk on Apple Podcasts, Google Podcasts or Spotify, where we're one of the most listened to financial podcasts in Hong Kong. You can go to my website, peterlewismoneytalk.substack.com, where you'll also find my daily newsletter. On Facebook, I'm Peter Lewis Money Talk, and on Twitter, at MoneyTalkR3. And as of today, I'm also on Threads, at Peter Lewis Money Talk. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the US gained 497,000 private sector jobs last month, roughly double economists' expectations and the biggest gain in more than a year. Following the data, Lori Logan, president of the Dallas Fed, called for an immediate resumption of rate rises. She warned if we lose ground in our effort to restore price stability, we'll need to do more later to catch up. Premier Li Qiang pledged to spare no time in implementing targeted policies to strengthen the Chinese economy's recovery from the pandemic. According to state-run CCTV, he said at a seminar Thursday that China is at a critical stage of economic recovery and industrial upgrading. He was quoted as saying that a slew of targeted, comprehensive and well-coordinated measures must be implemented quickly to stabilise growth and employment while preventing risks, but he didn't elaborate on what those measures might be. The Biden administration said on Thursday that it firmly opposes Beijing's new restrictions on the export of germanium and gallium, metals that are vital in semiconductors, 5G base stations and solar panels. The US Commerce Department said these actions underscore the need to diversify supply chains, adding that Washington would engage with our allies and partners to address this and to build resilience in critical supply chains. 30 million users, including me, have signed up to Meta's new Twitter rival Threads on its first day of launch, according to Meta CEO Mark Zuckerberg. Meta describes Threads, which is linked to Instagram, as a text-based conversation app on which people can post text and links and reply to or repost messages from others, and it has many features similar to Twitter. On today's programme, I'm joined by Francis Lund, the CEO of Securities, and Lashar, Asia Chief Economist at BBVA. And with a view from Australia is Toby Lawson, the CEO of Statton Partners.
Peter Lewis's Money Talk.
Investors sold stocks and bonds across the world Thursday after data showed the biggest gain in private jobs in the US in more than a year, and the Fed signalled more interest rate rises to come. On Wall Street, the S&P 500 and the Dow saw their worst daily performance since May. The S&P 500 lost 0.8% to end at 4,411. All 11 sectors of the S&P 500 closed in the red. The Dow dropped 366 points, or 1.1%, to close at 33,922. The Nasdaq Composite fell 0.8% to 13,679. Small caps were the worst hit, with the Russell 2000 index sinking 1.6%. The VIX Volatility Index jumped almost 9% to 15.44 as investors worried that higher interest rates will eventually sink the global economy. Bank stocks slipped in response to higher bond yields. The KBW Nasdaq Bank Index fell 1.6%. And US borrowing costs touched a 16-year high as the strong jobs figures intensified expectations of further rate rises by the Federal Reserve. The yield on the 2-year US Treasury note, which is particularly sensitive to interest rate expectations, reached its highest level since 2007. At one stage, it hit 5.12% before closing 5 basis points higher at 5%. The 10-year yield jumped 11 basis points to 4.04% after reaching 4.08% at the high of the day. Hong Kong stocks plunged by the most in 4 months, following the release of the Fed minutes indicating at least 2 more interest rate rises. The Hang Seng Index tumbled 577 points, or 3%, to 18,533 in the worst sell-off since March the 10th. Financials led the declines after it was revealed that Chinese banks have stopped buying bonds issued in the Shanghai Free Trade Zone due to heightened regulatory scrutiny, in a development that hurts local government financing vehicles' ability to raise money. The Hang Seng sub-index of banking stocks slumped 4.8%. That's the most since May 2020. Meanwhile, in mainland China, the Shanghai Composite slipped 0.5% to 3,206. And we're expecting the stocks in Japan and Hong Kong to open lower this morning. For the Hang Seng, futures markets are pointing to a loss of 150 points. That's 0.8%. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's Friday morning, and I know that because I can see sitting right opposite me Francis Lun, the CEO of Securities. Morning, Francis.
Hi, good morning, everyone.
And joining us this Friday morning, the Shah, Asia Chief Economist from BBVA. Morning, Shark.
Good morning, Peter.
Well, let's start with that US data because it's quite stunning. The US gained 497,000 private sector jobs last month. That's roughly double what economists were expecting. It's also the biggest rise in more than a year, according to data from ADP Research Institute. Thursday's data showed big increases in the hospitality and leisure sectors, as well as in construction and transportation. Now, tomorrow, in contrast with the ADP figures, we get the government's official jobs data, and that's expected to show that hiring growth slowed in June. Economists are forecasting that the US added 200,000 jobs last month. That's down from 339,000 in May. However, the median forecast has underestimated jobs data now for 14 consecutive months. So France is probably going to do it again, aren't they? Because this is incredible run of job gains.
I think the economists and the statisticians got it all wrong. They underestimated the growth, the strength of the economy, especially like if you talk about hospitality sector, it means people are taking more vacations, going out and spending money. So the recession will never happen this year.
Why are economists missing this? Is there something wrong with their models, or has the nature of the economy changed?
Yeah, definitely. I think they're missing a lot of things in the calculation. They just haven't done anything right. Let's see what Shalom.
Well, we have an economist with us. Not that we're pointing fingers at you, Shark, but nevertheless, come on, tell us what's gone wrong.
I'm not covering U.S. economy.
Oh, that's a get out, yeah.
That's good.
We'll get to China in a moment, though.
But it is true that if you look at the job market in United States, I'm afraid that people, they have some kind of a preference change after this pandemic. So their attitude about work is different from before. So that's why many of these parameters in the models no longer function. So that means the economists one day try to estimate the market situation. I think that they need to refigure something. Yeah, I'm afraid that's why they underestimate the job market situation. But frankly, I have to say that now the United States, the economy of the United States is overheating. So you have such a tight job market. We haven't seen that for many, many years. So that's why I worry this in future, this tight market job market situation will become the main driver of the inflation.
Well, what's interesting is there was also some other data from the US Labour Department, what's known as the JOLTS survey, which shows you job openings and also how many people are quitting their jobs. What is interesting is that the number of people quitting their jobs increased by 250,000 to 4 million, the highest in 9 months. Now, that's an unusual situation, isn't it, where people just voluntarily keep on month after month giving up their job. And it also tends to suggest that they're actually quite confident that they can get a job when they want one.
I think part of it has to do with the KOL economy. People can act on Twitter or Facebook or whatever, TikTok, and then if you build up an audience of about 1 million people, you can make money from it. So people are doing becoming their own self-employers already. So that's why People don't want to get tied down to a job and then have to conform to the company policy and things like that.
And also more people are trading in the markets as well, aren't they?
Right,
That seems to be another reason why people don't want to go back to their old job. But it is, Shark, isn't it? It is a new feature of the economy, this, and maybe this is one of the reasons why not just economists, but the Fed as well is sort of is missing the trends in the job market, because there's no doubt it's an incredibly tight labour market there.
Yes, of course. Now, this social media, they provide more channels for people to work and make money from them. At the same time, as you said, maybe now people, they are interested in trading to get some money. And that's why we have such a tight labor market situation. But the problem is this one is cyclical, right? Now, because we have a tight market situation, so that's why people don't afraid of lose jobs, because they are confident that they can easily find a new one. But the problem is if one day we successfully control the inflation at the cost of the economic growth, and then you will find the economy cannot create that many jobs. And then the things will be reversed. So let's see. I have to say that after pandemic, everything looks new, okay? But eventually, let's see what's going to happen. And remember, now the artificial intelligence, they develop very, very fast. Maybe in future, we don't need that many people
to do the work. Out of work already.
But the thing is, this is linked to the economy overall, isn't it? And also to the forecast for inflation. So there's really no sign of a recession yet, is there? The bond markets have been predicting it for a year. Economists have been talking about a recession, but it's hard to see how a recession can come where there's this many people, still working or not happy to quit their jobs.
Yeah, when you have an employment rate of 3.5 or 3.6%, it shows for the U.S. at least it is called full employment, because people have no difficulty finding a job. I think last year some of the big techs fired some people, but I think the slack have been picked up by the service sector and the hospitality sector and other people. So I think American economy is doing much better than the government believes.
So the key thing is, what does this mean for the Fed? Well, I think Lori Logan, president of the Dallas Fed, has just told us she called for an immediate resumption of rate rises. She said if we lose ground in our effort to restore price stability, we'll need to do more later to catch up, she warned. And she said we've already had a fair amount of time to see the overall effects of monetary tightening. So I think, Shark, there's not going to be a pause this month, is there? We've had the 1 month pause. It's back to rate hikes.
Yes, so we do expect this month they are going to hike interest rate by 25 basis points. And now, according to current situation, if you look at this labor market situation, I'm afraid that they are going to hike interest rate again in September. So after this summer pause. But come back to the previous topic. You don't think we are going to see the recession? I really doubt about this one. Okay,
really?
Because
you think we will?
No, I think I have the impression that now people, they receive so many information every day and they easily put some things behind. For example, remember 3 months ago we worried about this regional banks crisis in the United States, right? So if you look at things from a longer horizon, you will know that we always have this business cycle.
And that's always already forgotten about, really, isn't it? That banking crisis. We don't talk about it anymore now.
Exactly. Yeah. So that means in future, maybe some other crises, bad things will pump up. Okay, I expected it, right?
Well, people are talking about commercial real estate. That could be the next thing that could be definitely the big crisis.
Yeah. But it already happened in China, commercial real estate.
It's a disaster. It's a disaster on the mainland, isn't it?
Definitely.
Yeah. So as an economist, I always believe this business cycle theories. I think you cannot expect this recession will no longer come back.
But this is a long business cycle, though, isn't it? It's a very long business cycle.
Yeah, maybe it
compared
takes
to
a few
normal
years
ones.
to materialize the next recession. Now everything looks great, but you never know.
So interest rates at 5% now, that's where the Fed funds rate is, at 5%, hasn't tipped the US economy into recession. Clearly the Fed wants to slow the economy. What has it got to get rates to try and slow this economy?
Well, you're running the risk of putting the world into recession. Already in Hong Kong, you have some feeling of recession already. Employment is down, and in China too, you have young people not being able to find work, and the renminbi falling sharply, and the stock market is not really doing very poorly. You have the IPO market completely drying out. And you have investment bankers with nothing to do.
That's a shame.
That's a shame.
Yeah, I think this talk reminds me that after financial crisis, Ben Bernanke decided to do this QE things. He told people that as long as we keep this low interest rate or very interest rate longer enough, then we will have the growth back. And now I think that if you want to have a recession, you just keep this high interest rate long enough. Maybe 5% not enough. Maybe 6%. 1 year is not enough, and keep the 1.5 year. Then I think eventually you will see the
what about
growth slow down.
20% like in the 80s?
We don't want that, do we? We don't want that. But this is, I suppose, for Hong Kong. I mean, as we spoke about on Wednesday's show with John Greenwood, we have no choice but to import US monetary policy, and it's not appropriate for the state of the Hong Kong economy at the moment, is it? So this is sort of one of the economic consequences, if you like, of the peg.
What happens? The high interest rate is causing a slump in the property market. People cannot afford to pay off their mortgages now. Interest expense have really doubled over the past year, and it's going up again. And for the ordinary people, they really have problem servicing their mortgages, and it's going to hurt.
What about the markets? It seems like US stock investors have finally started to realise that interest rates are going to go up further. I think bond markets have known it for a while, but stocks, they've really ignored everything that's been thrown at them this year, including high interest rates, including what you mentioned, Shark, the banking crisis, the geopolitical problems. They've just shrugged it all off, but we seem to be getting signs in recent days that maybe they're starting to take notice.
Yeah, I think now they realize that this interest rate hike will continue. That's definitely always the bad news for the market. So that's why I think you cannot expect that this good performance in the market, in the economy will continue forever, right? Yeah, because of this business cycle. So if they hike interest rate to maybe 6%, now we expect they hike interest rate maybe 5.5%. But if that raise higher, I think the market will have more correction.
Well, if you look at US bond yields, the 2-year Treasury note is now at its highest level since 2007. It hit 5.12% earlier today, currently at 5%. If you can get a yield of 5%, risk-free yield, why would you invest in stocks?
Yeah, that's definitely. But the U.S. market is still humming along. We only had the correction yesterday, but last night we have a crash in the European markets, like DAX and CAC and FTSE. They lost more than 2%.
Yep.
I think the recession warning is alarm has sounded in Europe already.
Well, they're talking about now of interest rates in the UK going to 6.5% at their terminal rate. So, but the UK is really a bit of a disaster zone at the moment in terms of inflation. What about the Hong Kong markets? Hong Kong stocks plunged the most in 4 months yesterday after those Fed minutes. The Hang Seng down 3% now, 3% yesterday to 18,533. A big hit was taken by the financials after Chinese banks said they were going to stop buying bonds in the Shanghai Free Trade Zone. This is another sign of how difficult it's going to be for local governments to finance themselves, isn't it?
Definitely.
Yeah, I think for Hong Kong market, there's 3 big bad news. One from United States. Now they are going to hike interest rate more, as we discussed. The second one from China. I think this related to the banking sector, because the banking sector, they have a very big exposure to the local government debt problem. And the last one, I think recently, many people in the Hong Kong market, they were expecting very big stimulus for Chinese economy.
Yeah.
It's not coming, is it?
Recently, from the officials' signals, it seems that they are going to be disappointed.
Really disappointed. I think you can. I think the Hang Seng Index will fall below 18,000.
Really? Where do you
Really?
think is the bottom? I mean, I know it's very hard to do this, but is there a lot more downside on the Hang Seng? Is there a lot more disappointment that can sort of come in?
Yeah, I think the Hang Seng Index can fall to at least 17,000.
Right.
Yeah, if the government doesn't act soon, it might fall to 16,000. That's terrible.
Right. So, how much are the geopolitical problems also weighing on the markets?
I think for these geopolitical things, people tend to accept that ones as a part of our life. Okay, so before they have these news sanctions, Chinese fighting back, and people they make very strong reactions. But now I have the sense that people take it as
They shrug their shoulders and say, "Okay, another sanction."
Of course, that have the impact on the stocks in this sector. For example, now China, they impose this export control on some metals, and then the metal sectors, they start to react. But for other ones, I really don't think these kind of export control things have a very big impact.
It's a dangerous position to be in, isn't it? Where sanctions now, we just shrug our shoulders and think of it as a normal state of affairs. It's not a normal state of affairs at all. But
that's not good at all. I think American policymakers want to stop the economic rise of China because they don't want to see China to grow to rival the U.S.
Now, Antony Blinken denies that. He says it's not about trying to stop the economic development of China, but you say that is really what's behind it.
That's what American policy shows. They want to stop the growth of China economically because go hand in hand with economic power is military power. Right now, U.S. is the only super power in the military sense. They don't want a China that can rival the Americans.
Isn't that more what the Americans are focused on rather than trying to stop China's economic advance? It wants to stop its military advance because it's afraid that China will use American technology against it, basically put all these chips into weapons and missiles. But the problem is the two are linked, I suppose, aren't they, as well?
Yeah, definitely. China already has more warships than America. China has more than 550 more warships already. What it really lacks is aircraft carriers. It only has 3, but they are really outdated.
So what can Janet Yellen do? She's arrived in China yesterday for a 4-day visit. Her goal is to find some areas of common economic ground, also hoping that she'll rebuild at least the communications between the two countries. Can we expect anything from this? What areas of common economic ground can they discuss and agree on?
Although I think many people, they are not very interested in Janet Yellen visit, but personally, I still have some hopes for them one. I think both sides, they have the willingness to stabilize their relation, especially for this economic relation. Many people said, okay, the United States and China, they will continue to compete. That's true. But I think that Janet Yellen's mission, at least she can talk to Chinese officials to make sure this kind of competition only confined to some specific sector, for example, high-tech sector, the chip sector. But as we know that the United States still have a lot of investment in China. If you look at the stock numbers, I think for example, Tesla, Apple, aggregately, I think they have more than $200 billion investment in China. So who's going to take care of their interest, right? So I think the Janet Yellen, she's coming here to stabilize the relation, to make sure, okay, we have this competition in these chips, but we just focus on these chips. Let's do the normal business in other areas. China, you need to open your market. Maybe you shouldn't intervene in your FX market, right? And they also have a lot of other topics like the debt relief for this emerging market. They have a lot of common topics to explore.
The problem is that the big topics are not really in Janet Yellen's area, are they? So these trade sanctions, that's really for the Commerce Secretary to sort out. Taiwan's not her remit either. So some of the big... But you mentioned one thing that I thought was interesting, currency. The US hasn't, they've got China on the watch list, haven't they? But they haven't described them as a currency manipulator. But the yuan is down 5% so far this year. Do you think that's going to be high on the agenda, discussing the currency?
No, I don't think so. I think U.S. interest rate is rather high on the agenda because U.S. interest rates are so high now, it causes distortion around the globe. You have renminbi falling to, well, maybe it will be a par with Hong Kong dollar by the end of the year. But for investors, it's really not very good because global investors will not invest in Chinese stocks if the currencies keep falling. And that's not very good.
But what can be done about that? Because, you know, obviously this is the remit of the Fed. They are independent of the government and they can't decide monetary policy to suit China. They've got to decide monetary policy to suit the US. And if you could argue that US interest rates are still too low at the moment.
That is the problem, I think.
Yeah, definitely. I think they will discuss about this one because a few weeks ago, I remember some people raised this issue that the United States, they consider to list China as this in the list of the currency manipulators. But of course, we know that now the depreciation of the Chinese yuan is not related to Chinese intervention, right? That's a market performance. That's market performance. But anyway, I think they will raise this issue because if you look at this real exchange rate, because China, they have a lower inflation. And then their money against the US dollar, they already depreciate more, right?
They should appreciate instead of depreciate.
So do you think it's getting to the point where the authorities are getting concerned? They're starting to talk about it more now, aren't they? We had the financial news saying that basically China's got all the policy tools it needs to stabilize it if there was what it called a panic slide. Is that a sign that maybe they are starting to get concerned?
I don't think so. I think the number one concern for the central bank is really the debt level in China, the real estate sector, and the local governments, and they are so heavily in debt that it will take a bailout from the central government to resolve this problem. So and the unemployment situation, that will demand more money for the central government to intervene. But they still have not come up with a grand plan to rescue the economy. So I don't think we can expect anything.
Well, Premier Li Qiang was talking yesterday about a slew of targeted, comprehensive and well-coordinated measures, which he said have got to be implemented quickly to stabilise growth and employment, while at the same time preventing risks. The problem was he didn't say what those measures might be. And we've had several government officials, haven't we, saying that that there's going to be sort of stimulus, as you said earlier, Shark. People are waiting for the stimulus. What can they do? They seem to be at a bit of a loss, don't they, as to what to do?
Definitely. It's not like Li Keqiang, the previous premier, who said half of Chinese citizens are at the poverty line. So we need the what you call is the hawker, the street economy. People selling on the streets to alleviate the employment situation. Maybe that's what the graduates have to do now.
Shark, what do you think is the priority? Is it the property market? Is it unemployment? What's the priority should be for the government?
I think that definitely China need to create enough jobs to rescue this economy, because now the unemployment problem, especially among the youth, is a very serious problem. Of course, I think in terms of these stimulus measures, they will continue to make more investment in infrastructure. That's okay. That's the very traditional way for China to stimulate the economy. I always expect...
But less effective, isn't it, these days?
Yes, exactly. And I think that they face more constraint on at local government level, because the local government, they already borrow too much. They cannot pay for their interest rate and principals. I hope they can find a long-term solution for this local government that issue. Because now they, as I said, they borrow too much, and we have seen this one again and again for a few rounds over the past 10 years. They decide to control the debt level and then slow down, and then they allow them to borrow more. So, but they must find a long-time solution for that one. I think the Chinese economy mainly related to confidence. Okay, if you convince people that the Chinese economy still have a very good futures, and then people, they can start to consume again, they can start to investment again. So, but you must find the long-term solution or long-term plan to convince people accept this one. Yeah.
Okay, well, fascinating discussion. Thank you both very much for coming in. Have a great weekend. You heard there Lashar, who is Asia Chief Economist at BBVA, and Francis Lun, who's the CEO of Securities. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
Well, a lot of focus once again on central banks. Australia's central bank held its official cash rate steady this week at 4.10%. It was quite a closely watched decision, wasn't it, Toby? Because we had two surprise interest rate increases before this month's meeting. So economists weren't sure if there was going to be a third one in a row. But in the end, the RBA stuck. Why did it do that?
Well, I think if you looked at the minutes of the previous meeting when they actually raised rates 25 basis points to 4.1%, it was a bit of a 50-50 call. So they were on the verge of holding the previous month. And then I think they looked at the data going through and started to see some signs of a little bit of slackening in the labour market, although it's still relatively tight, a little bit of decline in pressure on the services side, definite decline in on the cost push side in terms of supply in input costs. So those factors were sort of emerging through the previous month, and so this month it allowed them to be a little bit more patient. And to borrow a phrase that's quite relevant this week, they stayed in their crease this month and decided not to step out and raise rates. Having said that, they were very clear that this may not be it, and that there's more in the pipe, depending on what they see going forward in terms of labour market productivity, unit labour costs, services inflation, and the housing sector in particular.
This seems to be a feature, doesn't it, of quite a few of the major central banks, that even if they hold, they're making it clear that we're not out of the woods yet, and there's quite possibly more to come.
Well, it's all about expectations. We've talked about a lot in the podcast, almost on a weekly basis, about the concept that inflation is about expectations and getting embedded. And the risk the central banks want to avoid is that people get used to higher inflation. And one of the aspects of that is, human behaviour. If you can get away with a higher price and a better profit margin, you'll take it. And hence, what happens is that if there's no aggressive move to stop that from happening, either getting it embedded into the psyche of the consumer and of the producer, then you're going to end up with higher inflation over the long term, which is obviously damaging to the economy. So it really is. It's all about that. It's about saying, you know what, we still have work to do. We still have to try to keep the pressure down. Now, what you're seeing, and this is the concern you have when you have embedded inflation, is that the input prices for a lot of producers now have come off, right? So your supply chain concerns, input prices coming off as supply improves, but that's not necessarily being fed through to price reductions to the consumer. And that's because companies can get away with restoring some profit margin, which they'll do if they can, and the consumer's getting used to the higher price. This is something the Reserve Bank and other central banks want to avoid, and hence the language is quite aggressive.
And this is also linked, isn't it, to the jobs market? And in fact, the central banks themselves are linking the outlook for inflation to the jobs market, because I presume the linkage goes along the lines that if you're still in a job, or if you voluntarily quit your job but feel that you can easily get one back, that's going to sort of make your expectations of your spending ability much higher than it will be than if you were out of work. So is the jobs data, is the jobs market in Australia, is it fairly tight?
It's still tight, and it's a good point you raise, because if there's one thing that determines expectation of consumer, it's the likelihood of maintaining a job and getting paid. So that is a critical element in consumer expectations around inflation and around their economic prospects, is the labour market. And the labour market's still pretty tight. What concerns the Reserve Bank as well in Australia is that we've had some quite reasonable wage increases. Now, targeted, of course, to those who need it most, who are impacted most by the higher interest rates. But often when you raise labour costs, if you don't have an equivalent or a mitigating impact of higher productivity, then you're going to have an inflationary impact of these wage increases. So at the moment, the Reserve Bank's concern is that we're seeing wage increases coming across, which is not unreasonable given higher inflation, but we're not getting a pickup in productivity. And that will mean that unit labour costs go up. That means inflation gets sticky, and these are the issues. And then you end up with the sort of economic theory of wage price spiral, because companies continue to have to raise prices to pay higher wages. So the labour market's a key factor to consider.
And we had that data out of the US overnight, which shows there the labour market even tighter. The ADP data, which surveys the private sector, reported 497,000 new jobs last month, double what economists were expecting, the biggest rise in more than a year. Now, we do have later today the official US jobs data from the US government, and there economists are forecasting jobs to drop to 200,000. They were 339,000 in May. However, I should point out that economists have been wrong for 14 consecutive months now and have underestimated the jobs data. It looks like they may well be wrong again if you look at this private data.
We can't be too surprised when economists get it wrong, to be honest. But nevertheless, you're right. And what was most significant, this was one of the busiest sessions last night in terms of a reaction to economic data. This ADP figure really spooked the market. You saw the Dow move. You saw volatility as measured by the VIX go up 9%. So this is quite significant, and it tells you that tonight's non-farm number is a significant one for the market to look at. As you say, it's a 200,000 expectation. Unemployment, I think, is forecast to stay steady at 3.7. And the other factor, the other bit of data that's always looked at in here is the average hourly earnings, which we suspect, or at least is forecast, to be flat at around 0.3 on a month-to-month basis, and slightly weaker on a year-on-year basis, around 4.1%. So they're the things that the market will be watching closely tonight.
And what do you think overall this means for the markets? Because the Fed is making it clear, isn't it, that there's going to be more rate rises. Equity investors, have been fighting the Fed all year over that. But are they starting to realise that maybe the Fed means it?
I'm not sure if the market's trying to look forward, well beyond even the Fed, tightening. So when equity investors tend to look a fair bit forward to what they see, and they're really, up until probably in the last couple of days, felt that the Fed had been navigating quite well into a sort of soft landing, avoiding a deep recession, peaking interest rates at a terminal rate just over 5. And I guess what spooked them now is that the Fed have, made a fairly aggressive through the minutes and through commentary that 2 to 3 rate hikes are still on the mark, and that's probably the market underestimated that. Having said that, I still think that they feel that the economy can avoid a deep recession. We're not seeing a huge amount of dislocation, and the conundrum of the labour market being tight despite the slowdown in economic activity is something that maybe as a lag is yet to feed through. So I suspect the market was just a bit surprised by the aggressive tone of the Fed, given that they feel that the Fed has done a pretty good job up to this point of navigating higher rates without absolutely destroying economic activity.
Now, I suppose what's also significant is what's happening in the bond markets. The 2-year yield broke through 5% overnight, reached the highest level in 16 years, reached 5.12%. The 10-year broke through 4% as well. It's at 4.08 at the high of the day. This is becoming quite significant, isn't it? Because you're starting to get, first of all, yields at which, you're better off investing in bonds than you are in stocks. But also you have to wonder at what point does this start to slow the economy quite significantly? We must be getting to that point soon, surely.
Well, actually, the bond market, I thought was it has been fairly sanguine in this whole last 3 months. But to your point, they moved quite sharply overnight. They have been rising steadily in the last few weeks, and then I think overnight they got a 10 basis point move at the long end. And as you mentioned on the 2-year, hitting over 5% is quite significant. I think what is the terminal rate of 2-year bonds? We don't know. At this stage, the market had to reprice it basis what the Fed have been saying is that if there's 2 to 3 rate hikes, then 2 years probably had some room to go up. But what I thought was most significant was the level of volatility in the market and the scope of the moves overnight, both in equity markets and in bonds. It says the market was probably not prepared.
And Asian markets in particular have taken a big hit. Well, certainly here in Hong Kong, the Hang Seng down 3%. Yesterday. That's obviously because we've got to import that US monetary policy. But Asian markets in general are feeling quite unnerved by this, aren't they? The thought of at least 2 more rate rises from the Fed.
Yeah, I think it just plays out to the idea that the market got a little bit comfortable with the trajectory and maybe thought that things were over or at least had peaked for the time being. So, yeah, I think it's just a repricing of that. And markets have had a good run. June quarter was a really good one for equity markets. So it's not surprising that we'll see a little bit of pullback.
One exception, though, in the region, a notable exception, India, the Nifty 50, new record high for the 6th session in a row now. Indian stocks shaking off everything. They don't seem to be bothered about the global issues.
Well, the dynamics in India, are really good. I think it's a real growth story. And you have a look at the data. It sort of backs it up as much as, it might be a little bit of enthusiasm, foreign investors coming in. I think there was, something like 12 billion of inflow from FPIs in the last month. So there is certainly a lot of interest coming from outside, which is helping push prices and create a little bit of a momentum. But, when you've got growth at 6% on average, you've got unemployment at around 7.7, which is pretty steady. You've got inflation below interest rates. So you've got 6.5% on rates and 4.25% on inflation, and that's low for Indian inflation in general. You've got a fiscal deficit at around 6.4% of GDP. Your PMIs, both in the manufacturing and services, are in the high 50s to low 60s, and you've got 600 billion of FX reserves. I think all of those combined tell you it's a pretty good story in India. And you've got a large domestic market and you've got multi-generational, growth potential through infrastructure and what have you. So all of that stability is what investors like. And India is projecting politically, geopolitically, and economically a very stable story. And that is exciting investors, or at least it's enticing investors to say this is a good bet to invest more into India relative to other Asian economies. And so hard to argue with the story, Pete, when you look at those indicators across the board. And of course, you have to have a long-term view, and India is not a linear acceleration to success. But the fundamentals are there, and if it can be managed and they can avoid, and of course the other factor being on the external side, oil prices haven't really shot up, which is one of their major import of inflation, and that's one thing that's probably helped them as well.
You've made a very compelling case there for investing in India. Thank you very much for that, Toby. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Simon Kavanagh, Partner at BDA Partners. Providing a view from mainland China will be Shanghai-based independent economist Andy Scher. Have a great weekend.
Money Talk